There we go. Good morning, everybody, and welcome to our Atlas Mortgages webinar this morning, bright and early for us and sort of late afternoon for Jeremy. So thank you very much for joining us this morning. It's going to be a really interesting session just to understand a little bit more about the landscape of mortgages and home finance in Australia. And we're really privileged to have Jeremy Harper with us. He is a Atlas Mortgages, and he's also a chartered accountant, so he's right across this this subject. And we also have Brett Evans with us, so he is the Managing Director for EMEA with Atlas Wealth Management. Before we kick off, I'd just like to remind everybody if they can mute their microphones so that we don't get any background noise while Jeremy's presenting. And also to please feel free to pop any questions you have in the chat box and we'll get to them towards the end of the presentation. I always say the only silly question is the one that you don't ask. So no matter, even if you want clarification on something that Jeremy's covered in the presentation, or there's something that you're just a little bit unsure of, please feel free to ask it. This is your opportunity to kind of get all your questions answered. So without further ado, I'm going to hand over to Jeremy now and enjoy the presentation, and we'll be sharing the slides with you and also to a recording with you. So don't worry if you miss something, we'll be sharing all the information with you post then. Alrighty, I'm going to switch myself off now and hand over to Jeremy. Enjoy.
Perfect. Well, thanks, Lisa. Thanks for the introduction and good morning to everyone. Thanks for making some time. So today's presentation will go for roughly about 20 minutes, and then, as I said, we'll have Q&A at the end. So again, use that chat box for any questions that come up throughout the presentation. So I want to sit down and put together this presentation for expats to give you a bit of an update on what's happening in the housing and the lending landscape right now. I'm sure you've read the news. It's a real common topic, and the market across particularly the eastern cities is really quite hot at the moment. So I wanted to go through and explain exactly why we are where we are in terms of this boom and what are some of the factors and how that impacts you as an expat based abroad. So just a little bit of a disclaimer, obviously everything we talk about today is general in nature, and if you want to follow up with some specific advice, feel free to reach out to a professional for tax advice or legal advice, financial advisor, or myself for some specific credit advice around your situation. So a little bit about who's Atlas Mortgages, a little bit about us. We obviously specialise in working with expats across the globe, helping out in residential and commercial lending needs. And I think the main takeaway with Atlas Mortgages is the way we approach clients is understanding your specific circumstances, your lifestyle, the way you earn your income, and tailoring some credit advice that's specific to your individual needs, and not just treating you like a regular bank customer. A little bit about myself. So who's Jeremy? Well, so I'm originally from Melbourne. I started working in the mortgage industry sort of 5 years ago. Previous to that, I graduated university and worked in tax and finance for a number of years. So I am a chartered accountant, and I lived, like yourselves, I lived over in New York as an expat for a number of years with my wife. And so the reason why I got into specifically looking after expats is when I was in New York, I obviously, like any Australian abroad, they're everywhere, so I bumped into them. And when I was talking about being a mortgage broker, the common conversation was just how difficult it was to get finance being overseas. So that's when I decided to really narrow on my niche around helping out expats. And since then, I now live in Sydney, and like everyone else, I'm looking in the market and speaking to agents every week, so understanding the challenges in the real estate market locally. So today, a little bit about the agenda. What I'm going to be talking about is broadly the money market, in particular the RBA, the housing market, what we're seeing in some of the growth, the Australian lending landscape and how that's impacted the boom. I want to talk about some micro and macroeconomic factors in the Australian economy. Then we're going to move on to specifically around Australian expat mortgages and how that might apply to yourself. And I want to talk about some opportunities and challenges for Australian expats. And then finally, we'll have that Q&A. So again, put in your questions along the way and we'll get to those at the end. So this slide here I've put together is to talk about generally the RBA or the central cash rate. And on the left-hand side, I like looking at this timeline because as we can see here, the current cash rate in Australia is 10 points or 10% or 0.1%. And as we can see, the cash rate has been reduced over the last 10 years from 4.75% to 0.10. So when you look at that on a larger scale, we can see that the RBA supported the economy by reducing the cash rate more generally for borrowers, and how that's going to impact the lending side or as a mortgage borrower. So more recently, we've seen since November 2020 was the last time the RBA cut the rates, and they cut it by 15 points. And so Governor Lowe, who's in charge of the RBA, has come out repeatedly on the meeting minutes stating that the goal for the next 3 years around funding is 0.1%. And so they actually introduced a TFF, which is called a term funding facility. And that's given the ADIs, so the authorised deposit institution or the banks, the opportunity to go to the RBA and go to market and borrow from the RBA at 0.1% and then take that funding and offer cheap 3-year funding to borrowers. So that's why you're seeing the market really historic low 2 and 3 year fixed rates. Quite often you're seeing in the owner-occupied fixed rates starting with 1s, which has never been seen before. And so that's why banks have been able to turn around and get such cheap access to credit. So interestingly, what I've seen in the last couple of weeks is the 4-year fixed rate. So CBA actually were the market leaders. They moved this about 2 or 3 weeks ago. They actually increased their 4-year fixed by 20 points. And since then, I've seen some other lenders on my panel increasing their 4-year fixed. So perhaps that's signaling to the market that after that 3 years that the Governor Lowe has signalled, the cheap funding, we're going to see potentially an increase in that interest rate to borrowers. And then on the right-hand side, I've just overlaid a bit of a central policy for some of the established markets around the world, so the US, Europe and Japan. And as you can see, similar to Australia, their rates are sitting at 0 or even negative. So what does that mean for borrowers or people wanting to borrow money in Australia? This graph here is showing us over the last 18 months, so quite recent, how that's impacted owner-occupied variable home loan rates. So as you can see there, the new rate has decreased from 3.5%, which is that dotted line, all the way down to 2.79. So 71 point average has been a decrease in the last 18 months. That's a huge, huge savings on the interest rate on the everyday borrowers in Australia. So to put that in perspective, on a $700,000 mortgage, we're looking at a 9.2% reduction in your interest rates or interest payable on that mortgage. And I'll get to this later, but that actually means that that's helped turbocharge the borrowing capacity for borrowers in Australia, which is leading to part of this boom. So looking at the Australian lending, so this slide I found really interesting from the RBA, and this is on the back of COVID. So in Australia, we've had huge government support in terms of liquidity, in terms of welfare programs, increased welfare programs to Australians. And that's also overlaid the fact that Australians have been spending less. Number one, fear of COVID, and then number two, borders closed, so no international travel. And so on the bottom here, we can see under the savings ratio, if you look at that historically over the last 30 years, it's just skyrocketed. We're seeing 18% savings ratio, and that is overlaid with that top bar where we can see consumption, where it just dropped down last year, where everyone was just holding on to their cash and not spending it. So again, lower interest rates, higher saving ratio. These are some pillars that are going to lead into a bit of a property boom in Australia. And then finally, what I've got here is housing loan commitments. So this is excluding refinances, so new debt that Australians are taking out. And it's a breakdown from the RBA between investor demand and owner occupied. So if you can see that circle there that I've got there around 2015. So we had a property boom in 2015, which was driven by investor interest-only lending. So the investors were going to the banks were lending out huge amounts of growth in that investor segment. At that point, that's when APRA had to intervene. They saw that the market was overheating with lots of interest-only risky lending. So they came in, they introduced caps on the lending ratio for the ADIs over that period. So what we saw on the back of 2015, investor demand softened off purely because RBA put a real handbrake on that lending. Fast forward to 2020, 2021, we can see there the demand's not there from the investor lending necessarily. It's bubbling along. The owner-occupied demand has just absolutely skyrocketed to new demand. So at this stage, APRA is not as concerned because we're looking at borrowers that are paying principal and interest. It's a loan that they're going to occupy the house. And when we look at the reporting of the big banks particularly, there hasn't been any spike in their 90 days past due in their reporting, which means the loan quality on the back of this super high demand from owner-occupier, it's still strong, that loan growth and that loan quality. So at this stage, APRA is not concerned, but I guess it's a bit of a wait and see to see if this market continues to overheat, will they step in and put some lending restrictions on that segment. And finally, what I've got here is Australian housing market. So what I want to show here was, this is a year-on-year growth of nationally the property from a percentage growth. And so we can see when I was talking about 2015, we had that jump there, and that's when APRA intervened and put a real cap on investor limit around that interest-only lending, and we saw that the property prices started to level off. Then down at the bottom around 2018, 2019, we really did see the market there's a lot of uncertainty that was overlaid on the federal election. And so even the betting markets had Labor penciled in for a win. And so leading into that election, there was a lot of change around government policy, potentially around tax and property. And from that, it caused uncertainty around what people were going to do around existing property and buying property. So we saw a real decrease in property prices. And then on the back of, once Liberal had that victory, we saw a really strong rebound in property prices all the way up to early 2020, just before the COVID hit Australia. And that's where, if you can see recently, there's a bit of a change in that spike or that sort of downward trend. And what we'll see is in 2021, nationally, the housing prices will start to rebound to record highs. And so finally, what I want to talk about was the final part around the housing prices. And this is another key theme, and that is lack of stock. And this is a really key indicator. On the left-hand side, we've got new listings as a 28-day rolling average. And if you can see the dark blue, that is current year in 2021. And we started off slow, but we started to catch up to some of those historical years there as an average. But more importantly, on the right-hand side, all the way down the bottom in 2021 by itself is national listings as a 28-day rolling count. And you can see there, we're actually tracking 25% below our 5-year average. So what that means is for every one new listing in Australia, there's 1.1 buyers as a ratio. So at the moment, the demand or the supply cannot keep up with demand. So we're seeing there's a bit of a buying frenzy, and particularly when we look at specific stock, obviously with COVID, people are now looking for a house with a bit more room, potentially a home office, going from an apartment to a 3-bedroom. So that established detached dwelling with maybe a little bit of a backyard, a little bit of an office, that is in high demand. So there's more buyers than supply out there at the moment. So what I want to touch on now was just some of the micro and macroeconomic trends that I'm seeing. So firstly, in 2021, Australia's response to COVID, now my understanding from the Australian government and the health response to Australia has been world-class, and we have become a bit of a pedestal to what the government should look like in terms of response. So we've looked after on the health front, and now from that, the economy is starting to rebound with obviously an opening up economy, and people are looking towards that international investors to say, okay, it's a stable government, perhaps that's somewhere we need to invest into the future. Returning expats. So last year, some 400,000 expats did return to Australia, and additional 50,000 are expected plus. So we're seeing a lot of established expats with wealth coming back into Australia, looking for that forever home for the family to settle back home Record interest rates, as I said, the reduction in interest rate of 9.8% over the last 18 months on an owner-occupied loan, that has contributed in part to what we're seeing as a 20% increase in borrowing capacity with lenders. So particularly, if you've got a two-person application and they're wanting to buy a house to live in, they're now being able to borrow 20% more in terms of borrowing than they were, say, 2 years ago. Record low dwellings available, as I said, 25% below the 5-year trend. So this is also leading into that bit of a FOMO mentality in the market with buyers. Increase in savings, higher savings rates, so people are now using that savings ratio, that higher savings that they've got towards Australian property. Consumer confidence, and then finally an upsizer owner-occupied boom. So this is what we're seeing, that trend of people going away from apartments, and everyone's trying to pile into that same type of dwelling, which is obviously seeing a huge increase in uplift in value. So now I just want to talk a bit more about yourself as an Australian expat and sort of why you'd engage an Australian expat mortgage. So I've just got here some key themes for you to think about that may or may not be applicable. So firstly, refinance or restructuring loans. What we're seeing obviously with the lower interest rates, that there's some great offers out there purely just to take your existing loan and sharpening up that rate with the new lender. So to kind of give you a bit of a high level view, if you're looking to refinance, it's going to cost around $900 Australian with a discharge, a remortgage that you'll pay the state government, and then potentially an application fee. But there's lenders available on our panel that can do a $2,000 cashback because they want your business. So that will cover off sometimes that barrier to refinancing. And then in terms of rates, well, you're looking at interest rates of sort of mid-twos, low twos. So there's some great deals out there. So that's one key reason why you'd be looking for an expat mortgage. Purchasing a first investment property or continuing your portfolio, and that might be engaging to get a pre-approval, or if you're under contract to purchase the property, go ahead and get that application submitted. Accessing equity to purchase a new investment property. So this is, I think, a really great opportunity for expats abroad. If you've got existing property, no doubt you've taken your property's experience an uptrend in the growth of the value of the property, and therefore you've got equity available. And so with the record low interest rates, you could potentially access that equity to purchase a new property or to invest into other assets. So just as a bit of a back of an envelope calculation, if your property is worth $1 million, times that by 80%, so that's 800,000 equity. Subtract any outstanding loan that you might have on your property. So let's say, for example, you've got $300,000 owing. That means you'd have 500,000 in equity in that property sitting there. So you could potentially access that equity with that lender or a new lender and use that 500,000 as a deposit or to invest in other shares or other assets. So you've got lots of opportunity to use that equity. Fourth, I've got here funds to renovate or extension on that property. So we're seeing a lot of people with quite large land blocks, maybe adding a granny flat or extending out the existing dwelling to maybe make that a dual key. So turning that from a single to a dual occupancy, doubling your rental yield or adding an additional rental stream with another tenant, or actually just increasing what you can charge at market rate. So that's a great opportunity to extend what you've got right now and put more, I guess, increase the rental yield on existing property. Fifth I've got is construction of duplex or triplex. So this is, I'm seeing a lot of demand for this, where they do have existing clients have a substantial block of land. They might have one dwelling on it. They're going to knock that down and do a construction for, say, 2 townhouses or maybe 3. This is quite common where we can get the finance arranged. And the key to that type of lending is actually lending on the end value of the project. And we might be able to, if someone's got some questions, we can talk about it later, but that's actually the bank coming in and funding that based on the end value. So from a deposit required, we can use the existing equity that you've generated in the land value plus the end value on the build contract. And then last, purchase your future forever home. And so I've sort of split this out as an investment property because this might be a property where the yield from an investment just doesn't stack up. but you know that in 4, 5, 6 years' time when you come back to Australia, this property is going to be where you'll be living with the family, or it's going to be close to your existing family in Australia, and it's going to suit your needs. And so whilst you're overseas, you can use this opportunity to buy that property and then use your tax-free income to start paying down that loan. So when you do come back to Australia, you've now got a PPR with a small or even zero loan on it, and then you can live in it with your family. So some opportunities and challenges that I see for Australian expats. Excuse me. So opportunities. So access to record low interest rates. Now the really key thing here, which is great, is a lot of lenders on our panel will offer you the same rates as if you were based in Australia. So there's no penalty. I do have some lenders that will actually add 50 points on, but let's not talk about them. So the great thing for you is just because you're overseas doesn't mean you'll have to pay a premium of an extra 1 or 2% on your mortgage. Utilising your tax-free income and using that strategy to quickly eliminate this debt. And I think this is key. And I think this can get glossed over. Being overseas, if you're in a low tax or no tax environment, you can take that money and start paying down your mortgage. I live in Australia now. I'm now Australian tax resident again. I understand how much I need to pay the Australian government in tax every month. So why not use this opportunity being abroad to start paying down some of that debt, where if you're in Australia, you won't have that same opportunity. You can start or build an investment portfolio. So continue on your investment growth, and then leading into creating that passive income for retirement in Australia. So if you're looking to start or continue your investment portfolio, by the time you come back to Australia, you might have small or minimal loans on those properties, and that you've now start to collect that rental income when you're heading to retirement. So on to the challenges. I guess the first challenge is if you're trying to start your property portfolio, that the biggest challenge is you need a 20% deposit. Some lenders dictate a 30% deposit, so that has to come from cash or other assets that you can liquidate at settlement. That can be a challenge, particularly if you're trying to buy something worth north of 1 mil. So you have to put that savings to good use first. Lending is restricted generally to employee income. So if you're running a business overseas, we do have options that will accept foreign self-employed income. It's a little bit more restrictive, but most lenders, particularly the mainstream, will want you to be employed with an employee overseas. So the way they'd verify that is work contract and sort of 3 months pay slips. If you're looking to buy with a non-citizen spouse, so over the last 5 years, the FRB, which is the the Foreign Investment Review Board, which is a federal government body, and the state-based, so where particularly what state let's say you're trying to buy into New South Wales, the New South Wales SRO introduced an additional stamp duty surcharge. Now, both those are applicable to non-residents of Australia. The definition of a non-resident is different between those bodies. Generally speaking, if you're an Australian citizen living abroad, you're exempt from both. But if you're a PR, permanent resident of Australia living abroad, or if you have no status in Australia, maybe you're currently a UK citizen and your spouse is an Australian citizen, that's going to potentially cause you an issue with these bodies. Not necessarily the FRB, because the exemption is if you're in a marital relationship with a citizen, but on the state-based level. So if you were looking to buy a property as, let's just say you're a UK resident abroad, then per the New South Wales definition, you'd be classified as a non-resident. It's an additional 8% on the dutiable value of your portion of ownership. So if you just wanted to buy a property with your Australian spouse 50-50 and it's worth $1 million, then that 500,000 is subject to an additional 8% stamp duty. So it's quite expensive. So you'd have to sit down with your tax accountant and work out how can you structure that to try and minimize that expense. But that is a challenge if you're looking to buy with a non-citizen. And then the last challenge I've got here is just making sure you've got a trustworthy team in Australia. So buyers agents, builders, property management. If you've got property in Australia, you want to make sure that you've got a respectable professional that can manage the tenants and make sure that it's not causing you a headache whilst you're overseas. And particularly if you've got builders or you're trying to do a project, making sure you've got a project manager or someone that you can trust to make sure it actually gets delivered on time. So that's the end of my presentation. I'll sort of throw it over to the room and see if there's any questions. Or if you've got any there, Lisa or Brett.
Oh, yes,
Yes, Jeremy, the first one. Oh, sorry, Lucy, you go for it.
No, you go.
No, just a quick one here from Gcon Boy saying, hi, Jeremy and all. From an investor position and generically speaking, is it better to have a principal and interest mortgage or interest only, and what are the benefits of both?
Good question. So I guess you have to think about your tax status. Interest only lending became really popular with accountants a number of years ago in Australia because obviously you can claim all that interest and not pay down the principal. So the benefit of interest only if you're an Australian tax resident is you claim the interest and your cash flow is reduced, so less outgoings towards that investment. You can keep that cash flow for other investments or lifestyle. If you're a non-tax resident of Australia, which I'm going to assume you are, I personally think that looking towards a P&I or principal interest repayment strategy works better for you because two reasons. You're not getting a tax benefit, and any negative gearing you're getting on your properties in Australia, that's a credit that you'll carry forward on your Australian tax return till you become an Australian tax resident, which might be 5-6 years down the track. So you're not really getting the benefit of the interest only. You'll also get the access of lower interest rates if it's a P&I loan versus interest only. And so if your cash flow can support it, and perhaps you're in a maintain your portfolio, not necessarily you want to expand and take on more investment loans for additional properties, I'd be looking at a P&I strategy. But if you're looking to expand your portfolio, perhaps looking at interest only with an offset.
And I think one thing I'll also add there, one thing I'll also, on top of what Jeremy was saying too, is it doesn't necessarily mean the end of the world if you do push through into positive cash flow. Yes, the ATO does tax you at 32.5 cents on the first dollar, but remember there are planning strategies you can employ, like concessional contributions to super, that are able to negate or remove the tax liability on that. So you can almost have your cake and eat it too. But you just need to make sure your numbers are correct, and as Jeremy said, what your strategy is. But certainly, if you are paying P&I, your interest cost is going down, which pushes you up into a positive cash flow. Then always consider the next step when it comes to managing your tax liabilities, because we see a lot of folks who don't know that they can make concessional contributions into super and claim that as a tax deduction. The other one too, and I'm sure Jeremy will agree, is surrounding depreciation allowances. It's amazing how many expats we meet who don't know they can get a depreciation allowance on their house. And that too can help you soften the blow from paying to the ATO any money that you may not have to.
Yep.
Thanks very much. Cheers.
Brilliant. I've actually got a quick question. Actually, there's another question that's just come through. But I was quite interested in, because obviously if people are looking at purchasing their forever home, we'll obviously start off as initially as an investment loan, and then assuming that you move back in 5 years' time, does that then convert to a PPR loan? What are the land tax implications and CGT implications of that proportion of sort of investment versus PPR loan?
Yep. So going through some of those questions, you can get it set up as an investment loan. So if you're looking at, okay, we're going to set this up as investment, and in 5 years' time, as part of our strategy, this will be our forever home, then I'd be looking at a P&I loan, so you can start paying down this loan whilst you're abroad. And then when you come back to Australia, you'll have, obviously, if you've still got a mortgage balance, what we can do is go back to that lender and give them evidence you're now occupying the property, and that loan will get converted, provides a variable loan at that point. It will get converted by that lender from investment to owner-occ, which means simply a letter, and they'll reduce your interest rates. We don't need to refinance it. We just prove that you're now occupying it. From a land tax question, so you do have, that's going to be state-based because every state has different thresholds and different rules. If it's a high land value of the property, then yes, then you might be subject to annual land tax until you move into it and it becomes your PPR, and then of course that becomes exempt from land tax. And then from a CGT point of view, that would be something you'd have to clarify with your accountant around. If you become a tax resident, is it a deemed disposal date when you become back into Australia, and what does that do to your cost base? versus, because once you live in the property, obviously you're not subject to the CGT because you've got your PPI exemption of main residence. But what does that impact have on the coming back into Australia that date?
One thing we recommend to clients is certainly have the valuation date as of the purchase date. If you do buy a forever home in advance, if you're coming back, when you land in Australia, get an official valuation on the property, not a property appraisal by a real estate agent. You need to get a registered valuer to ascribe the value to that property as of the date that you are becoming a tax resident again, because what it does do, it demarcates your I guess your journey as an expat and your changing tax status. So as a non-resident, you don't get access to the 50% capital gains discount. As a non-resident, there are different tax implications as opposed to a resident. So as Jeremy said, you want to demarcate those two periods because that is, where there is a change in your domicile, and also to the asset itself changes in the way it's structured. Obviously, once you move into it, then you do get access to the main residence exemption and those sort of considerations. But certainly you need to really draw a line in the sand when it comes to, moving back to Australia and getting that valuation. You can get backdated valuations. The further it goes back, the more the cost, because it's more work. But long story short, you can just pretty much tick those boxes quite easily as long as you do the right things in the proper order.
Thank you. I'll read out. We've got another one from, sorry, my font's really big, but how about non-home loans, such as a personal loan to invest or a margin loan? Have the rates dropped? And are there any complications for expats with this, looking to take advantage of the lower interest rates this way?
From my research, personal and margin loans for people based abroad is just sort of a no. It's just too difficult. The lenders that I've got on my panel don't like that. If you've got property and you can access equity, 50,000 loan to go and invest in shares, that is definitely something that can be done. But personal and margin loans, no, not from Australia. You might need to look at a local provider.
Yeah, we've gone through this quite a bit with a number of clients over the last 24 months. Essentially, there's three main providers of margin lending providers in Australia. They've all said no. Then the issue is if you are looking at a local provider, and as Jeremy said, the only way you can really consider it is a refinance on existing finance on a property in Australia. Overseas lenders will not do that because they can't get access and security to the equity.
We've got a question too from Matthew saying, how is the amount of the loan you are able to secure determined against your expat salary?
That's a good question. It's probably a bit too general, but the way I guess it works generally in Australia, if you look at like a DTI, so it's debt to income of gross income, you'd be looking at sort of a 6-7 your maximum. That's pre-tax. But if we were talking about income that is tax-free, that's a bit of a different calculation. And then also we need to factor in things like, so when we're looking at borrowing capacity, some other things we need to factor in, and this is a good question actually, is not necessarily just what your wage is, but also what's your living expenses. So your month to month are you a single? Is it a couple? Do you have dependents? Are you renting? How much is your rent each month? Have you got a mortgage overseas? How much is your mortgage? And then more importantly, and this is a good point around extending your borrowing capacity in Australia, is banks on the servicing side don't look favourably upon things like car loans overseas, personal loans. If you've got HECS in Australia, that's a really big one, because the way they calculate the repayment on your HECS is a percentage of your Australian income. So if you're earning over 100,000 in Australian dollars gross, it would be 10% of your yearly wage, not on the balance. So those things will actually reduce your borrowing capacity in Australia.
Excuse me, Jeremy, it's Matthew. I asked a question. If you don't mind, can I just ask a quick question? Or a follow-up?
Sure.
Sort of late last year, I was talking to a mortgage broker in Australia. I was interested in purchasing a property. I went through the process of filling out all the paperwork and explaining what my income and expenses were. And I was surprised at the end of the process to find out that the loan amount I was allowed to borrow against my sort of salary versus expenses was treated as if it was an Australian income subject to tax, even though I'm a non-resident for tax purposes. And that significantly reduced I suppose, what I would have thought was the benefit of earning an expat salary. So in other words, you're earning an above average Australian salary while you're over here. I happen to be in Saudi Arabia. But you would think that would be able to leverage a much higher loan amount. But in fact, it turned out to be less than somebody earning a relatively modest salary in Australia itself. And it just sort of shocked me a little bit and made me think, well, then what is the actual benefit of applying for the loan while you're over here if the value that I'm earning? Yeah.
So what that means is that person you spoke to and that bank, because some banks have that policy. So to give you a live example, Commonwealth Bank, they'll take, if you're earning, say, dirhams, they accept that as a currency. They'll convert that to Australian dollars. They'll shade it by 20%, and then they apply Australian tax rates on it. That's their credit policy. So I would never look at borrowing capacity with CBA for someone in the middle or someone on dirhams, because it's not reflective of your actual cash flow. But there's plenty of lenders that will service your income on net of tax. So they'll take your after-tax income, and if you're not paying any personal tax, that it is what your gross is. They'll convert that to Australian dollars. Most of them will shade it by 20%, and we take that as net of tax, so we don't apply Australian tax rates. So with those lenders, your borrowing capacity will be much, much higher than your calculations last year. So I'm happy to run those numbers with you if you'd like.
Yeah, for sure. I'll get in touch with you later. But thanks for answering that. I appreciate it.
Jeremy, do you also want to touch on the way that the different banks treat the different currencies? I think it's an important point that you mentioned as well too. Even though the dirham is pegged to the US dollar, we don't get the same benefits as someone, say, earning USD.
Yep. So every bank has different policy on how they look at it. So ANZ has a quarterly BCRF tool, and they just have, I think it's like an average FX of the last quarter, and that's the conversion rate. Most banks will just use a spot rate. So if we go to xe.com, convert that across, and that's the spot rate that will convert from dirhams to Australian dollars at that date of application. And some lenders have their own calculations, like NAB, I know, will have an internal FX sheet that they apply, and then they actually shade that back. So again, they're not a great lender because their FX conversions are rubbish compared to market, but it's trying to find those lenders that will convert at today's rate.
So essentially, as a tier one, we've got US dollars, Hong Kong dollars, Sing dollars, pounds, euros. Is that correct?
Yes. Yeah. So it depends. Some banks don't have tiering. Some banks will accept all currencies. Some, like Commonwealth Bank has their tiering called gold and silver. And then some banks will just have a list of currencies they accept. And if the currency is not on it, so for example, Saudi Arabia Rials, that's not on a lot of banks. They just don't accept it for some reason, whereas some do, but not all of them have the tiering.
I think it's a great point about ensuring you're talking to someone who actually knows what they're talking about, because you got to know which banks to talk to, and also think to the risk department and compliance departments for the respective banks are changing the rules every week. So just because they were doing something last week doesn't mean they're doing something the next week, and vice versa. They may have said no to expats 3 months ago, but now they're saying yes to expats now.
Yep.
We've also got a question from Maurice, who she was recently contacted a property investment agent in Australia and was told that was doubtful that she would get a loan for an investment property being non-resident for tax purposes. They currently have a loan with St George for a property in Perth. Is that the case, or she's just been given incorrect advice?
No, that's not the case at all. If you're non-resident for tax purposes, did you say, sorry?
Yeah, she's a non-resident for tax purposes and is
so
investment property.
So from a tax status, the only impact that has on lending for tax, so if you're a resident or non-resident, only impacts it has is don't get negative gearing benefit on the servicing calculator, which means that if you've got a negative geared property or loan, then if you're an Australian tax resident, we can add that back for servicing. So it might increase your capacity by, say, 4 or 5%. That's really the key difference. we can't claim that back, but that doesn't impact your ability to access lending abroad. The key criteria for Australian banks under expat policy is making sure you're an Australian citizen. So if Louise and her spouse are both citizens, then we can look at expat lending.
Great. And there's another question too from David saying that can you expand and give a little bit more information on what's considered self-employed for a loan mortgage in terms of expat? So does self-employed mean that they own the company and are the only employee, or what are the parameters around that kind of definition?
Yep, good question. So lending definition of self-employed is if you've got more than 25% controlling interest in the company. So if you've got a shareholder registry and David owns more than 25%, that's classified as self-employed because they've got majority influence on the business. So if that's the case and we do fall under self-employed, the banks would need to see 2 years business tax returns and 2 years personal tax returns. I'm not sure what you could get together around that in your locally and from a tax point of view reporting locally, but that's what the banks would want to see in Australia.
That's obviously so 2 years tax return.
Yes, financials, 2 years financials of the business showing that income's coming into that individual's name as well.
Okay.
And normally they'll just get a local accountant to sign off in that one day too, Jeremy?
Yes. Now there's actually, I do have one option. I'm sure people have heard of a low doc loan for self-employed in Australia. I do have an option around that as well, as if you don't have financials to present, then you can get an accountant's declaration to sign off, supported with 6 months business or private bank statements to show the credits or the income coming in, and the accountant can sign off and say, okay, that's the income coming out of the business and then flowing through the individual for servicing purposes. But ideally, I would aim for 2 years financials and tax returns.
So obviously the challenge is, David's come back and said in Dubai, we don't really, VAT is probably the only tax that we have. So it's probably a little bit challenging to furnish 2 years of tax returns. But would 2 years of financials be sufficient, or they actually want to see some sort of government sanctioned information?
Yeah, I think I'd have to look at those documents and chat with the lenders and come back to him on that specifically, because the challenge is with self-employed income, even in Australia, when you go to a bank and you present yourself, your financials and tax returns, they do add an extra level of scrutiny versus PAYG in Australia. Of course, when we're talking with income overseas, even if you're PAYG, the banks have another layer of verification, work contract, pay slips, bank statements. So I would just have to see what the bank would be comfortable around if we can't get tax returns, but banks just need that level of certainty around to verify.
So there's also a question from Sandra, a very quick question. She's asking whether it makes sense to use their own capital to develop a piece of land or borrow once we are back in Perth. So I'm assuming that they have some land in Perth. They're non-resident for tax purposes currently, but whether they're better off borrowing now to develop the land as non-tax residents, or whether they're better off waiting until they get back, until they repatriate.
And would this be, I think there's a few things to consider. Would this be something purely for investment? This land, is the land vacant at the moment, or is it, do they have a tenant in there?
Sandra, why don't you take yourself off mute and then you can maybe kind of provide a bit more information if that's okay.
Sure. Hi everyone. Well, quick question. We've had a piece of land for about 10 years now and haven't done anything with it. It would be a second home, actually. It's a holiday home.
Okay. And so currently there's no dwelling, there's no income coming off this property?
Absolutely none. Yeah, absolutely none.
And is it unencumbered at the moment, or do you have a mortgage on there?
No, there's no mortgage on it, no.
Okay. So you could look with a construction loan, if you're wanting to put one dwelling, what you can do, particularly if you've got vacant land, you've got a lot of equity there just sitting there, and you've got a property with no income coming in. So I would be thinking why not explore the idea of getting a construction loan or start building on the property whilst you're overseas? That way it's complete and you've got income coming in versus waiting until you get back to Perth. That would be my idea. But the way that would work is if you would engage a builder locally and you agree on a fixed bill contract to build the one dwelling, the bank will do a valuation. They'll go, okay, what's the value of the land, the parcel of land, plus the fixed bill contract, and that becomes our as if or end value that the lender will lend to you against. So in that scenario, you could essentially get the full construction cost funded by the bank and not have to put any money down, and then you could take your funds and put that in an offset account with that lender. So net, you're not paying interest because you've still got the cash there in Australia, offsetting the loan, but then you've got the flexibility of not actually having to put all that money down towards the build. And if you need to take those funds for other uses, you can take that out of your offset account. And then you start having the income coming in.
Sorry, Jeremy, the question was, is it better to use our own funds or to borrow once we're back in Australia? Because we're just waiting for the flights to start again so we can get back. So it's only a matter of like 3 or 4 months or something before we're back in Australia.
Oh, okay. So if you're, I guess I would probably potentially look at using your own funds. Will you be in between jobs at the moment?
Yes, that's right. That we would be in between jobs and.
Okay. Yeah. So that would probably cause a servicing issue. How to verify your income for the loan. So in that case, maybe look to use your own funds if you want to start that ASAP. Start the build.
Right. Thank you.
No problem.
I think, Lisa, too, there was another question there from Alistair just a bit earlier on, I think we might have missed. He goes on to say, as an expat non-tax resident, will a bank consider your equity calculation more harshly than a resident? So, for example, 70% LVR versus 80%. Also, how do they look at different currency for servicing, of some more favourable than others? And is there a way to improve your position if your income currency is seen as less favourable? So I think we've touched on the currency side, but you just want to touch on the LVR side.
Yeah, so LVR, so a lot of banks will go to a maximum within the expat lending space, maximum 70%. There's a lot of banks will go up to 80%. So that's fine and not an issue to get the equity out up to those. Only one lender on my panel, CBA, will go into mortgage insurance territory. The rest will stay out of mortgage insurance territory. And that means if you want to go over 80%, banks will start to charge mortgage insurance. So that's the key restriction. Whereas if you're in Australia, you can go up to 90, maybe even 95%, depending on what you want to do. You just have to pay the mortgage insurance premium. In terms of the last question was improving serviceability.
Yeah,
I think that
by declaring obviously which currency,
yeah, I think from a serviceability point of view, the key is just making sure your own assets and liability are nice and tidy for the application. So reducing or closing out credit cards that you don't need, because the banks will assess your repayment of a credit card 3.8% every month on the limit, not the balance. So you might have 50,000 dirham credit card that you only put $1,000 on each month. The bank will look at 50,000 because that's a facility you could draw down on. Look at maybe paying some of that HEX off if you've got a small balance, because that will increase your capacity. And then if you've got any personal or car loans that you can start paying off, that may or may not have a material impact on how much you want to borrow in Australia. You might be able to keep them open and still get the loan, but they're just some things that you can look at to increase your capacity.
Thanks a lot, guys. Answers the question. Thank you.
Not a problem.
Okay, I think we're sort of winding up, and I don't think there's anything else that we've missed in our Q&A. But definitely once the webinar is finished, I'll be sharing the contact details of Jeremy Brett, and we also have James Ridley on the call. He's a managing director for Atlas Wealth, and he looks after the Asia Pacific APAC region. So definitely there's the opportunity to reach out to either Jeremy, Brett or James post this webinar and to seek any clarification or contact them in regards to securing some mortgage finance or investment finance. So they're very, very approachable, the team from Atlas Wealth, and more than happy to answer any questions that you have. I don't know, I'll hand back maybe over to Brett and Jeremy and just see if they want to wind up a little bit.
Oh, that's just, yeah, I just wanted to put that to my contact details there if you want to drop me an email or make a booking.
And also too, Lisa will, when she sends the email around, she'll also include Jeremy's slides as well as a copy of the recording as well as the contact details as well. As Lisa mentioned at the beginning of the call, you know, what we've been able to achieve is a bookended solution here with myself and the team located in Dubai, combined with Jeremy in Sydney and James on the Gold Coast. You know, the biggest tripwires that we see with a lot of expats is either talking to the wrong person, getting the wrong information, or going down the route and not investigating all of the implications and complications that go with managing your assets as an expat. So certainly the key thing is doing your homework in advance. You may be able to get a loan, but in terms of how you structure it, it may not be the best scenario from a tax point of view, or it may be just something that you could actually get a better solution if you just speak to someone with, you know, who operates in that space on a daily basis and is MatchFit. So just want to say thank you to everyone. Just a heads up too, we do have a big mega event happening next month in May in conjunction with the Australian Business Council. And that's going to be a big finance seminar in person. So I think people are getting a bit Zoom fatigued. So this will be an in-person event. We should be finalising those details over the next week. And essentially what we're going to be doing is running through a summation of the budget changes. The budget comes down in the second Tuesday of May. So this will be a summary of those changes as well as property, equity and currency market updates, as long as legislative changes. There are quite a lot of changes occurring in the superannuation space. So keep an eye out on your emails for that, because we'll be sending that information out over the next week.
That's great. Thank you very much. I'd like to say a huge thank you to Jeremy, to Brett, and also to James, although he didn't, is operating in the background for this particular webinar. And we really appreciate everybody's time. I know everyone's busy, and I know that you know, webinars are a bit exhausting. We look forward to seeing you hopefully in person where possible for the finance event in May, and I'll send out more details for that shortly. Thanks again, everybody, for your time, and have a fabulous weekend.
Thanks, guys. Take care.
Cheers.
Bye all.